What's going on, everybody? We're waiting for Patrick to join the stream. He accidentally joined the wrong thing. So I'm going to wait for him in just a second. What's going on, everybody? How's everybody doing? Let me know in the chat. What's going on, DP? What's going on, EV Bike? Let's get it. Let me know if you guys can hear me while we wait for Patrick. Here we go. Patrick is here.
Sorry about that.
You joined the wrong thing.
Yeah, no, well, it's funny because the message came on Twitter, which I just had on my phone rather than on my computer, so it took me a few seconds.
You literally commented on the same thing I put. Like, I'm in the Zoom. I was like, how? What's going on?
Not too much. All is well. How's everything there?
Your quality of studio has improved so much over the past few months. It's unbelievable.
You know, it's mainly just it's a new camera and a new microphone, and actually, it's all about the camera, I think, more than anything.
So we have a lot to talk about today. Some
Yeah.
insanity going on. Before we start, a huge shout out to Super Donkey with the phenomenal name. Here comes the Rambling Show. Oh, brother. He's referring to Matt Kors, I think. Did you see my interview with Matt Kors, the guy from AMC?
You know, I missed that one. I didn't see that.
Very smart guy. I was really impressed.
Tell me about what happened.
So he's kind of the person who started this whole AMC movement, or at least one of the initial ones. And he's a really level-headed guy, very pragmatic. He's not hyping up nothing, and really knows the stuff, knows the numbers, knows what he doesn't know. It doesn't comment, and then pretty much the correlation -1 to me. So had a lot of fun. He broke the studio. We had like 6,000 people in the stream.
Wow.
He's pulling Joe Rogan numbers now, like 50, 60,000 concurrent viewers every stream.
Wow.
Yeah, big numbers. So first of all, let's say hello to some people in the room. That's for you, Patrick.
Yes.
Here you go. I'll do the same thing for you as well.
Stay sitting, Tom.
Don't get up. No, I have plans, I swear. That little movement cost me a little stroke. That's my exercise for today. Let's get it. Two living legends. Let's get it. We have your friend from the UK, Sasha, in the house. Is angry for the football. I mean, I don't care. You and me don't watch this. Greetings from LA. Let's go. Naked Shorts. It's such a great name. If we ever form a band, you and me, we call it the Naked Shorts.
Sounds good.
I think it's just fair. It's between that or not a financial advice. It's one of those. You got another donation from Yijalma. Can Patrick do a video where he sees Palantir going for the next 1 to 5 years? Oh, that's a great. We never spoke about this.
You know, the bad thing is I know next to nothing about Palantir, and I don't know much about single stocks. Like, it's kind of the problem is listening to me. It's like listening to someone you meet at the bus stop on some of those topics. Like, I know certain things and other things I wouldn't add much value on. So
it's such a divisive stock. You either love it or hate it. It's like Boris Johnson. You can't stay. You can't ignore it. It makes you feel something. Or Donald Trump. Okay, so Palantir keeps bringing in these contracts daily. Every day we hear about some new contract. I'm a huge bull. I don't know if you know this, Patrick. You should know this.
I have. I've seen you've almost moved away from Dan Bilzerian towards Palantir and AMC.
Yeah.
You know, and I think I speak for most of the audience that we need another Dan Bilzerian video, or at least thumbnail. You know, you can talk about other things, but just Dan Bilzerian in the thumbnail.
Prison. The Prison thumbnails were so much. I used the same thumbnail for like 47 videos. Prison. I I do the same thing for AMC, and they're like, "You're using the same thumbnail." It's like, yeah, that's like the whole point. That's exactly what I'm doing. So Wes Frey says, "Oh, this dude, I like this dude. Which one? There's two of us. You need to be more specific, Wes." I'm gonna assume you're referring to Patrick, since
Well, he
think
did
that's
log into your channel. You know, Wes, if you'd rather, you could go and watch stuff on my channel while Tom and I chat.
So let's talk about the phenomena that is what's going on right now. While I highlight some chats just to show you guys some love here. So Patrick, is this even a thing in the UK? I mean, obviously, for those of you who don't know you, which I'm assuming they have to live under a rock and to be on this channel not knowing you, but you are the founder of a real hedge fund, not one of those made up ones. You are in academia. You're a professor. You're a writer. Finance. How should I put you? One of the best finance people, definitely on YouTube, probably beyond. And you generally know what the fuck you're talking about.
Hopefully.
So, having said
Sometimes.
that, yes, an esteemed member of your community, much like correlation -1 to me. What do you? Is this even a thing in the UK? I mean, you're located in London. Is this something even people talk about as much as
You know,
it's
it's
here?
a funny thing because, to be honest, like I got a few messages on my channel the other day saying, "Why have you not talked about AMC?" And in truth, I guess I just view it as the same story as GameStop, and I kind of did a few GameStop videos, and I've, you know, to a certain extent, I've kind of moved on from it. But I mean, in truth, it is just the same story, same stuff going on. You know. It's not that not much of my day goes into looking at the news. Like I mostly actually know about it from your channel and that sort of thing.
By the way, there's a question here about dark pools. Do you have that in the UK? Does it work the
Well,
same thing?
this is a global thing, and it's kind of interesting actually because it relates to, you know, I watched your video from this morning, and it's kind of a funny thing the way market microstructure works, because what happens is, you know, many of us, we kind of, you know, we sort of know about the old stock exchange. You know, initially people sort of trading stock certificates under a tree in New York, and then they built a building and things got more technically advanced, but not a whole lot more advanced for quite a while. And you know, the existence of dark pools and all of this, what can I say, sort of non-exchange trading, is something that kind of came around in the late 1990s. And it's very interesting because right now these firms are looked at as being kind of villainous. And you know, the truth is that everyone's trying to make money, and there's sort of good and bad things about them. But initially what would have happened, you know, actually I made a video, it just touches on it, but there's one of my old videos called, like, I think Day Trading in the 90s or something like that, sort of talks about how these guys came about. But basically there was this old approach where kind of there were the big market makers, like big sort of investment bank type firms that made markets in all of the NASDAQ stocks. And then there was the New York Stock Exchange. And what happened was that a bunch of kind of smart techie .com type guys came up with ideas. They basically saw that retail investors were getting screwed by the NYSE specialists and by the NASDAQ market makers. And they worked out ways around it, you know, and this is kind of where the day trader came from, because these guys basically, there was a piece of software, it's still kind of around, called NASDAQ Level 2. And if you were a market maker, you had to register as a market maker, and you were allowed to use NASDAQ Level 2, which showed you the full order book and allowed you to trade in certain ways. And so these guys were licensed as brokers, and they kind of were doing some brokerage business, but then they just decided to start trading for their own account using this software, which you weren't really supposed, in fact, you definitely weren't supposed to do. And they even had some funny things where they would, you know, because there was supposed to be a customer behind each order, they would kind of get a bunch of friends and family to invest some money with them. and they do these trades kind of for their own account, but they sort of put it in this friends and family customer account. It was really skirting the law, and they did get in trouble for this. But they basically worked out that using the software that the market makers had, they were able to take advantage of the market makers, and they were able to do all sorts of things. Because how it worked was usually all of the trades were done over the phone, but NASDAQ did require market makers to put a certain number of they had to make a market electronically between themselves for a small number of shares. And so these guys would see the stale pricing, use their software to grab that stale price and basically run it up in the face of these market makers. And the market makers hated them. And there's stories of a lot of them, like Daytech was the big firm that then went on to be Daytech, the brokerage. But there's stories of market makers realizing, they've been screwed over 50 times a day by the Daytech guys, and they come storming across the road into the office and like attack a guy at his desk. I mean, it was pretty crazy. But anyhow, at Daytech, they had some really smart technology guys. I think the guy's name was Adam Levine. He was, I think he still has a website, but back in 99 when
he also has a band called Maroon 5.
Does he? No. Oh, well, no, but he had this live webcam in his office, where he was there doing all of his work, and you could just log in and watch him working. It's kind of an early internet sort of meme thing, And so anyhow, he basically built an entire exchange off the exchange because he wanted to be able to, with their firm Daytech, which had then Daytech Online, which was a retail brokerage. They were able to just cross people's orders in the pool, right? And if they could cross people's orders, they could give them much better fills than they could get by going to NASDAQ. Now, as you can imagine, the guys at NASDAQ went insane over this, and there was all sorts of legal wranglings and whatever, but this was sort of the first of the dark pools. And there was Archipelagos, which was just, almost a spin-off on the name Island, which was the original exchange. And so they set up these sort of off-market exchanges, basically to give better pricing to themselves and to retail customers. And so that's where this kind of off-exchange trading came from. And it did actually improve the markets quite a lot. But then, of course, there's always problems because we're adding complexity on top of complexity. So it moved to a point where there's like 20 or 30 different places you could trade, right? Which is complicated. And then all of the market makers and all of the brokerages or the off-market exchanges basically wanted to attract people to their exchanges. And in particular, there were certain types of customer they wanted more than others. And so they came up with these things. They wanted liquidity, right? Because if you start a new off-market exchange, the problem is if someone comes to buy there and there's no one there selling, you don't really have much of an exchange.
It's the classic network effects of...
exactly.
Yeah.
And so they came up with this idea of having, and this is sort of one of the big disasters, I think, that happened. But on a bit of a whim, I think it was this guy Levine at Island came up with this idea that that you could have maker and taker, that if someone provided liquidity, they would get a rebate from the exchange. And if you sort of reached across the spread to either buy or reached across the spread to sell, so it was sort of, you were either a maker of liquidity or a taker of liquidity. And so one would pay a fee to the other. More complexity, which didn't work out to be good. And it kind of goes on and on, but all of the big kind of smart quant stock traders got involved in this stuff. And people like Bernie Madoff, in fact, were also, they were the first market maker to pay for order flow. And that was a big deal at the time. And that's sort of the problem we're seeing today in markets. And the question is, is that reasonable or not? Now, the thing that's kind of complicated about this is that how does this work? Like, who is hurt and who is not? Now, the truth is that these market makers or these pools, they want to pay for retail order flow, okay? Now, you might say, why do they want to separate retail from institutional? And at first, your idea might be, well, it's to rip off the small guy, right? But interestingly enough, market makers, they have kind of an interesting business, right? Because you basically register as a market maker and you're able to trade there with the flow of orders that comes into the market. And you put up two prices, the price that you'll buy at and the price that you'll sell at. And your goal, like the perfect thing is if the market goes sideways all day long and you're buying at one price, selling at another price, making money all day long. What goes wrong, though, this is a bit of a pennies in front of a bulldozer problem, is that once in a while, someone will come in and buy from you, and so you sell it to them. They'll buy again, you sell it to them again, now you're short, okay? They'll buy again, now you're getting shorter. Now you're like, oh, now you have to buy, right? So then you back off on any offers to sell, and you just start crossing the spread yourself in order to buy because you just want to get flat, right? So what they hate, what market makers hate, is someone who will come in and do that, right? Because they get caught either short or they get caught long when a big move happens in the market. Now, they worked out that the people who were definitely doing this to them were big traders, right? Like if Fidelity comes in, and Fidelity will say on a Monday morning, comes in and they're buying Apple stock, it might take Fidelity a week to get a fill in Apple, and they're going to buy. And if you're a market maker, you're getting hammered by this because you have to participate, but when you participate, they just hit you again and again. And not only that, all you back away on one side, all of the other market makers are kind of backing away. And that's actually kind of how markets move up or down, but it's unpleasant if you're a market maker. So they wanted to separate these people because they think of retail traders as sort of random, right? In that someone's buying, someone's selling for whatever reason, but they tend not to come in and buy for a whole week and just run you over. And so they actually give better fills, at least in theory. This is the idea behind it, and this is what they'll tell you. And it seems reasonable to me. They'll give better fills. They'll be more aggressive to get retail order flow simply because one guy will be a buyer, one will be a seller, and you can deal with them all day long and grind out this profit. But they really hate dealing with kind of the big guys who run over them. And so they want them in separate pools. And so Citadel will pay Robinhood to send stuff their way because that's random and they can make money in that. But they'll try to avoid, they don't want like George Soros in there, like, running them flat, right? So they want to separate them. Now, what's happened recently with AMC and GameStop, and just with kind of the changes that have occurred in markets, just the rise of the retail trader, is that retail traders are kind of deciding together. They're sort of coming up with ideas on message boards, and they're all going to the market. So suddenly, Robinhood, that used to feed these guys this nice random order flow where one guy's a buyer, one guy's a seller, and you just get to make you get to introduce them and make money, right? Suddenly now they all turn up and they're all buyers, and these guys are so now they're getting run over by the retail traders. So this is sort of where we are with this. And it's something that, we'll see over time. Like market structure always changes because it's kind of like an evolutionary process. It doesn't necessarily mean it always changes for the better, but it always moves such that people can survive, right? Because if the market makers get hammered, the market makers go away, market doesn't really function. And, one of the things, I don't know much about this, the kind of DeFi thing with, the new ideas for how markets might work. But one of the things that's interesting is possibly eventually the elimination of middlemen, that kind of might mean that traders can face each other using some sort of technology that, is self-funding. But, we have to see but it's, right now, I think, I guess that's probably my 20-minute answer to a question of can I explain dark pools? So that's sort of where they came from, but they weren't set up like a lot of people look at it today and they go, oh, there's this nasty thing where they're ripping people off. But it's a funny thing, and there's pros and cons. And the thing is that, whenever you're involved in transactions, you're winning and losing. And, the other side is always trying to win. And we shouldn't be upset that someone else is trying to win. We're trying to win too. But the thing that happens is just that there's kind of this constant change. But when I started out, like many years ago, my first trading like was over the phone with guys. You used to either deal with guys on the floor of the exchange, or you'd put your own guy on the floor of the exchange in order to hopefully get ripped off a bit less, And I remember being on the phone with these guys, and we used to put some big orders in, and you'd give them a big order, and they just clap their hand over the phone, and they tell their friends around them what you were doing, so their friends could front run you. You know what I mean? And I remember once I had to deal with a guy like that, and I heard him distributing the order to everyone before he headed out himself. And I said, "Did I say buy? I meant to say sell." The guy nearly had a heart attack. But I mean, so the thing is, you're always dealing, like when you're buying and selling stuff, you're always, it's like and it's not just stock markets. Like you're dealing in real estate, you're dealing with people who try and rip you off. Anything you're trying to do, and there's good guys and there's bad guys, and there's different incentives. But that's kind of but I was just going to say that it's just different things that are happening. But in truth, when I look at it, like 20 years ago, the prices you had to pay to trade were just so much higher. The speeds and everything, like it was a way worse. Things have gotten better and worse. The problem back then was
The
that
user experience was trash. The UX was trash.
Well, it was, but even you were also being kind of ripped off, but by a guy, if you know what I mean. While now a guy has programmed a machine to rip you off, which doesn't feel good either. And it feels almost more fraudulent because it's maybe more provable. But the truth is, I don't know, I'm torn on this thing because it is cheaper to trade than it ever was before. It's not free is the only thing. Like when people say to me, I get to trade for free, I'm like, you really do not get to trade for free. Like if you ever think there's something you're getting for free, check again,
So that's a great topic. I 100% agree with you about the whole concept of free or cheap. So, and I've been very vocal about it. So my opinion is quite clear. I'd rather pay a fee and not have my data distributed, but it's just me. So a question for you, and that's a topic that gets misunderstood even by me a lot. By the way, I'm gonna give a huge shout out to Evie Bike Dude for the coffee money. Thank you so much. In Russian,
it's in Irish, slancha.
No, yeah, but in Russian it says "Твое здоровье." It's like to your health.
Same thing in Irish, so yeah.
Okay, that's what I did here. Nice. So shout out to you. He's a long-time viewer. So, hey, Patrick, can you explain the whole idea basically and about how payment for order flow is good and bad at the same time? I mean, what are obviously the good stuff that it brought, such as cheaper trading versus the bad stuff that it creates?
It's interesting because it's very much that sort of thing. It's good and bad, and one of the big problems even is just the growth of complexity in markets. So as I said, it used to be guys under a tree buying and selling from each other, and they do what they would do as well. But we've moved to what happens is there's markets just constantly get more complex. So we'll say, for example, when we move from the world of one or two places you can trade to 100 places you can trade, and they're all server farms, they're not like places. And what happens then, there have been all sorts of rules. Like there was a rule, I'm trying to think when it came out, but it was called Reg NMS, which is National Market Structure. And the idea about Reg NMS was that because you've got the same stock trading in 20 locations, the politicians thought, well, this has obvious problems associated with it. So we're going to require that brokers have to give their customers the best posted price in the country, right? So that basically means that you have to kind of flash the order to all of the exchanges, see where the best price is and try and get a price there. The problem is that gives up information. And so there's other ways then that you might get front run and that sort of thing. And then they passed other rules to kind of change, that sort of improved upon that. But it's a constant back and forth, it's an issue. In truth, a lot of this stuff, like the real one of the real lessons for this is that for a lot of people, like if you're a medium to long-term investor, this stuff doesn't grind you up that much, because how do you get ground up? At the casinos, like the game of craps, the dice game, it is one of the cheapest games to play at the casino in terms of the house take, but it's also one of the fastest games, right? So it's play, play, play. And therefore you get hammered playing that game. And so one of the things that I would say to especially a retail investor, if you are a retail investor, even if you're told you're trading for free, you're probably paying a decent fee to trade. You don't see it, you don't get a receipt, but you're paying, okay? And the one way to minimize how much they chew you up is just to minimize how much you trade. The more you're in and out, the more it harms you. And that's even, there's a very interesting thing because I've a very free markets approach, and I think people should be allowed to do whatever they want to do. But when you look at apps like Robinhood, the reason you don't want that is it's like a casino on your cell phone, right? And all the confetti and everything else that cheers you for doing a trade. That's encouraging you to trade more. And usually that won't help you. Like that definitely will help market makers. It'll definitely help Robinhood. You're probably better off making really good decisions and sticking with them than sort of while you're sort of waiting for the bus doing 30 trades on your phone. It's not a winning idea.
And it's coming from a high frequency trader. So it's
but actually, it's interesting because almost anyone I know who trades fast and who trades a lot, one of the things that I really care about is slippage, and I love if I can reduce the amount I trade, because that becomes the more I trade, the more it costs me over a year, and there just is a cost. And once you acknowledge that, you look to just keep that down.
I see it like a casino. When you play in a casino, the odds are stacked against you slightly, but they're stacked against you, like 49.9% or something. So the longer you play, on average, the longer you're probable to even out the odds against you. So if you can hit a good hand, you probably won't leave. The same thing with the market.
It's interesting because I would say that in terms of fast trading, the odds are stacked against you. And there's a list of reasons, even just running up taxes, like even with Joe Biden's new like capital gains rules and so on, like that's going to hammer you if you're a short-term trader, right? It just is. It's not good for what you're doing. So one of the things I would say though is that I have a friend who argues
even before Joe, below a year, you're in short-term capital gains, which is double.
Yes, you were. Yeah, and even that's even why people like to trade futures rather than stocks, is that you get a better tax treatment. But when we look at what was I going to say? I'm sorry, I've entirely lost my train of thought.
Good.
Oh no, I remember. I was going to say that it is like a casino, but most of the time you're on the winning side of the table, right? Because generally, stonks go up, okay? In the long run, if you look at any long period of time, you do well by being an owner of companies, which is what you are as an investor in the stock market. And so you are set up to win unless you make mistakes.
It's the sentence that Warren Buffett said: the stock market is the best transfer mechanism of wealth from the impatient to the patient.
Yeah.
So
I mean, the thing is, there's someone a while ago, I got attacked for saying, for saying that trading doesn't make money. Trading can make money, but it's hard, and you have to have a really good system. And it's kind of like, the way a good blackjack player, they follow Ed Thorpe's rules. They can turn up, and in theory, if they follow the system well, they can grind out a profit. That's true with trading as well, but most people neither have a system nor do they follow it. And that's when you get chewed up. Like once your emotions get involved, you do all of the wrong things.
Again, the same thing like in the casino. When you get emotional, that game over. So a question here for you, which is actually, I like this question a lot. I don't know the answer. It's so the Massive Attack is asking, what do you think of the possibility that money managers are writing buy orders through dark pools and sell orders through the lit market to gain more control of the price? For example, like people who are short on AMC for that purpose.
So this wouldn't actually work the way markets are structured because it's actually due to that point, the legislation that well, firstly, for every buyer there has to be a seller, but on top of that, it's this idea that Reg NMS just means that the orders have to sort of hit every exchange at once, and you have to be given the best price that can be achieved. And so, what really just would the orders go where you can get a fill, and if a broker were to give you a different fill on one exchange than on another, that would be breaking the law. I don't think that happens. The markets are really fast. They are, computerized, and basically, how it all consolidates is what there's called the SIP, which is, what does the SIP stand for? It's basically the consolidated tape, which is the feed from all of the exchanges put together, and you have to be given a price that's at or better than what's showing on the SIP. So that wouldn't work. That would both be illegal, and the markets aren't really wired for that sort of thing to work. Oh, I'm not
Yes,
hearing it. Oh,
yes,
okay.
yes, it's me. Patrick knows nothing is free, 100%. Somebody thinks I'm not drilling you hard enough. What do you want me to ask that I didn't ask? I mean, that's
Yeah, ask some questions. Like, I'm happy to, I'll give the
where's the
best
money?
answers I can.
um, okay, so there's a question here I do want to pull up. Hold on, where is it? Somebody's spamming the same thing. Hold on. Okay, wait. Can't find it. So, anyways, can't find the comment, but somebody asked. I'll just.
They put it in 30 times and then it's gone.
No, it's running so fast. So somebody asked. I can't find the comment right now. They want your thoughts on the New York Stock Exchange president basically coming out and saying, well, meme stocks have lost all correlation to any sort of logical pricing, and it's now just this craziness.
I mean, that's true, in that the price reflect, but this is not this isn't surprising to me. Like, that is an accurate description of events, in that, normally you might say that the value of a company relates, when you buy a company, you are receiving the sort of cash flows that company receives through their business. When we look at some of these stocks, like the price is entirely unrelated, and it's just tied to the short squeeze. And these two examples, the closest thing I can think to them in the past is kind of the Volkswagen squeeze back in, I think it was in 2008, and so it's not surprising that they're unrelated. And actually, it's worth noting that will affect kind of market maker quotes as well, because we'll say in a normal stock, in a normal market, one of the things we'll say, if a market maker had sold some Coca-Cola to a trader, and then they come back to buy more Coca-Cola, the market maker may not be able to offset their risk instantly in Coca-Cola, but they might buy some Pepsi shares, right? Because of the correlation, or Home Depot's at Lowe's or something like that. So they might be able to reduce their risk with a correlated thing. Because the meme stocks aren't correlated to the market, like it's not about whether it's an up day or a down day in the market. They are their own thing. And for that reason, it's sort of going to be difficult to make markets in those things. And there's a bunch of, it's a fascinating market because there's so much technical and interesting things going on in it. Like, even just the way options are priced and whatever in these stocks, simply because you've just got this insane level of vol, and it throws off a lot of the Greeks that a trader would typically use to hedge them.
So I don't know if you had a chance to watch the interview that Wes Christian did with the community from GameStop called Superstonk.
No, I
Uh,
didn't see that. No.
so he's a very well known securities litigator, and he's an
Oh,
advocate
I've
for.
seen clips of him on your channel, I think. Yeah.
I can't. Yeah, I feel such a fanboyish reaction every time you say watch my videos. Uh, so basically, so he was talking about the fact, and you probably saw this on my channel, that he doesn't think that the reported short interest has anything to do with the real short interest in the stock because of all the manipulation and all the miscategorization, basically mismarking, everything that's going on in the market. So do you, I mean, you've worked in this industry for many, many years. I obviously can't ask you whether that's true or not, but do you think it's plausible what he's saying or not?
It's an interesting thing because I watched him and I was a little bit confused because I guess I would look at this and think like if someone were to sue, you'd sue because you had lost money because of market manipulation, right? But it would appear to me that the people who are upset about possible market manipulation have made an awful lot of money, right? Like, because it's, the people they're saying are, shorting and knocking down stocks are losing money. And so I don't know that you get to take their money and then sue them for you know what I mean? Like, doesn't there have to be a demonstration of harm to your financial well-being?
I think
I
the
think
people
a
who
lot
would
of
sue, who would have to sue in this case, is the people who held before the short squeeze. Let's say that I mean, I think he was referring to legitimate shareholders that came in, I mean, during the regular course of business, and then got basically artificially pushed down from like 12 to 2, whatever, like because
yeah,
of
it's really hard to know because even when I watched his thing, I kind of thought, he was talking about possible like class action stuff, and generally I'm a bit, lawyers seem to me to just be people who extract fees. Like a lawyer's never made
well,
me
that's like the
money.
whole
It's always
point.
cost me money,
But
so.
that's the whole point. It's a win-win.
And I kind of think like when people talk about class action, like you pile into a class action, it seems to me that Saul Goodman makes a lot of money, but you don't, so.
Wait, so I have to push back here. I don't often do this with you, but I have to hear. I'll
Oh,
explain
no,
why.
no, I'm interested.
Class action lawsuits are not designed to make any of the group members any money. In fact, you get cents. You get
Yeah,
nearly
yeah, you
nothing.
get nothing. Yeah.
The only people who make money are the lawyer and the representative plaintiff. The device though is really good for a different purpose. It's designed to basically create a penal system, like a negative
To
incentive to
teach a
people
lesson,
to teach a
basically.
lesson. Exactly.
Yeah.
So you join the class not to make money. You get like 50 cents or or free popcorn next time you go to MC. What like, but the payout, sorry, that comes out from the defendant. It creates like a penalty. Basically
Mm.
says, oh, if you do it again, or your friends, whatever. So uh, they're important tools, and that's why they work like that. They easily you can say, well, the only lawyers make money. True, but that's
Yeah.
part of
Yeah,
this.
there's a
That's
different purpose
yeah,
there. Okay.
yeah. So moving on from that, so I see that this question keeps popping up. I don't think people are getting. It's a complicated topic. So again, it's the same question with different phrasing. As you can see, I don't know if you can see on the screen. I can read it to you if you want.
Let me read.
It's the
No, I
same
mean
question that the
the
other.
truth is like all
Can you explain the
trades have
mechanics?
to
So
be.
so if you explain the
Yeah,
mechanics,
I don't on the off top of my head know the timing, but you have to very quickly, like once you've traded, you have to report the trade, and even ways that you can sort of hide your trades. Like one of the interesting things that came out of that Bill Huang blow up there about, I don't know,
Archegos.
about a month ago, Archegos. One of the things that was interesting was that he was trading through total return swaps or contracts for difference, which essentially just is kind of like a bet. It's a derivative that means that he bets on the price going up. He gets the entire return, so dividends and capital gains, but his name doesn't show on the shareholder register. And I think the news seems to say he did this for the purpose of privacy and possibly so his brokers didn't know how concentrated his bets were. That's kind of interesting. But when that even happens, what happens is, if a broker, like we'll say Morgan Stanley, sell you, you basically buy a CFD on a stock from Morgan Stanley. Morgan Stanley then will buy that stock themselves as a hedge, right? Because they don't want to take the other side of your bet. They just basically, you'll see on the shareholder register, Morgan Stanley is the big holder rather than your name. But there's not really, I don't think there are mechanisms for buying and selling in different locations. No one, the markets wouldn't work very well if that was kind of the way they work. Like it would be a very disjoint. The thing is that there's a whole bunch of traders in most of the, we'll say, non-market making high frequency traders, or what we'd call arbitrage traders. And they've set up computers that basically look at the prices everywhere. And if we'll say, for example, even if I'll give you an example of how they might trade. We'll say with a product like soybeans, there's soybeans, then there might be soy oil, soy mush. I don't know what they call it. There's a whole bunch of different soy products.
You're starting to sound like Bubba Gump from Forrest Gump.
Well, there's a bunch of different products that come from the one thing, which is a soybean. They will monitor the price of all of these things. And if one gets out of whack with the other, they'll buy the cheap one, sell the expensive one. And you can always sort of hopefully convert one into the other. That's a thing they'll do with something as complicated, we'll say, something like soybeans. With stocks, there's no way that a high frequency trader would allow it to trade on one exchange at one price and another, because it's too profitable. They're just lightning fast. They've got microwave towers set up between the exchanges, because the light will move faster through air than it will through fiber optics, right? They care that much about speed. They're not letting two prices that are different exist, because that's just free money to them.
So I just want to make it clear. This is coming from somebody who's actually an expert on this, and not me, since I don't know nothing about this. But there's no technical way to create price discrepancy using dark pools. That's not what this thing is for. It's basically it's completely visible if you trade, unless you engage in something illegal, right? Unless you just don't report your trades.
I can't think why that would be illegal, and also I still don't even really see the advantage in doing that. Apart from like the disadvantages that it's illegal, but that's just not really the way markets work. Like there's so many people with different ways of profiting, and they all they kind of all police each other.
You have a huge compliment from Buford Butters. I'm assuming that's his real name, legal name. I've been trading full time for 10 years, and these two are my favorite finance investment market YouTubers. Somebody, Courtney Adams, saying Tom and Patrick proving nice guys do exist in finance. It's yeah. I don't
We're
know if
horrible once the cameras are off.
I'm an asshole. I don't know who said. If you think
I've heard that.
You can ask Patrick. Okay, so another question I want to ask you. So, technical question. Again, not talking specifically about AMC or any specific stock. How reliable do you think, when I look at Seeking Alpha, how reliable is the number that I'm seeing for short interest for any company versus the reality?
I actually don't know with that. Like I can't actually answer that. You'd have to ask someone who runs Seeking Alpha, because there's possibly time lags or things like that, but I don't really know.
Here you go. A simple question for you. What is the origin story of Palomar Capital Management? And then he's throwing some shade. Some stories that we can't find on Google.
Oh gosh.
Oh wait, it's not shade.
Well, amusingly, there's an old film around, actually it used to be on YouTube, but it's gone, where around the time that I launched the fund. But it's basically just I launched it, when was it, back in around 2011, sold it in 2019, and stepped down as a director about 6 months ago.
So should I be nervous if we close below 60?
Are you long or short?
I think that's what she said. We're getting demonetized so fast. It's true. No money for me. Oh my god. Somebody says, I trust Seeking Alpha as much as I trust someone on the street trying to sell me jewelry. That's the fun part of not being affiliated with anybody. I don't have a sponsor. I can just laugh at this. Okay, so another question to ask you is, I've heard a lot of discussion. I don't know if you heard this. Obviously, you're not deep into this AMC. Well, hold on a second. Ugh, another super chat. 1 second. Eduardo Alva, thank you for the $5 donation, is saying Citadel has been fined for many reporting violations, but they continue to do it because it is the cost of doing business. You can look it up on FINRA. I mean, that is true, actually.
Yeah, I mean, I haven't looked that up, so I don't know. And
I mean, all
yeah,
market makers, they get fined every once in a while for
yeah, and
compliance
you'll
issues.
probably find that with a lot of very big firms, just because things might go wrong. But like if he says that, I'm sure that's true. But I haven't looked it up. I don't know.
It's like when Wes was doing his interview, he was saying, I think what he's referring to Eduardo here is basically Wes was saying, well, these they almost prefer to pay fines. Not specifically talking about Citadel, Wes. He was talking about the market in general, but Wes was basically saying, well, uh, large institutionals and market makers and brokerages basically treat these fines as a, like he said, cost of doing business. They don't really look at it as anything that's supposed to change the way they operate. I guess that's the comment.
Well, I
Uh,
guess it also depends on the size of the fine and the reputational damage. Actually, I thought it was pretty interesting. What was it? In the last day or two, it was in the news that something like 10 big banks were excluded from being involved in a euro bond offering, I believe, simply because the EU said that they had been involved in scandals in the past, and so they would not deal with them. And it was, I won't name any banks because I know I'll name one that wasn't on the list and get in trouble. But if you look it up, it was like 10 of the biggest banks you can think of. And something like that, like actually losing real business for sort of repeat. I think there were a number of the banks that had been involved in like the LIBOR fixing scandal and things like that. And that's actually what needs to happen, is that people, big customers need to say, I will not deal with you because you're a dishonest counterparty. And I think that is something that can move the needle. I thought that was a very interesting story.
I have a great question for you, but before that, there's a super chat. And Nestor is asking, what do we think about the due diligence for GameStop on Superstonk? I haven't fully read it. I just saw bits and pieces of it. I'm sure Patrick didn't read it as well yet.
Yeah.
But there's a very lengthy due diligence posted on Superstonk. Is kind of the GameStop channel now. All the
Oh,
GameStop
really?
people
It's
left
no
Wall
longer
Street.
Wall Street Bets?
No, they left the form this thing, and it's super clean. It's like just the due diligence, no memes. They're really a lot of good
Oh.
stuff there. So a question right up your alley. I'd love to hear your answer for this. Which fraud CEO would you interview if you could? I mean, Skilling is the guy from Enron, right?
Enron, yeah.
Who's
I'm trying to
Ebers?
think.
Who's Ebers?
But that was WorldCom.
Of course.
Gosh, I have to think through the list because there's probably some really interesting ones. Gosh,
Live?
I don't know.
Do they have to be alive or dead? I mean, if you can just do anybody in history, Bernie probably.
Bernie's kind of interesting, but I don't know. No, I
Ponzi,
don't know actually.
maybe
Even
Ponzi.
like Elizabeth Holmes is kind of fascinating to me, just because it's such a strange story. Like I
Yeah.
must admit that I find that one a combination of hilarious and insane.
So check this out. So Elizabeth Holmes, for those of you who don't know this, it's Theranos. So CoffeeZilla actually did a video where he found James Corden making a satire of Theranos, and they called it Ficanos, basically like a
Oh, yeah, I've
stool.
seen that one. Yeah.
And then and then there is a company that's basically exactly that. So the meme have been beaten by reality.
Yeah.
Um,
Did you
somebody
see
says
his recent what is it, USDT
Tether,
one?
the Tether one.
That's a wild story, isn't it?
That's his best video to date,
Yeah,
easily, in
for
all
a
aspects.
variety of
Yeah,
reasons. Yeah.
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 Editing, research, delivery, everything.
If you guys haven't,
That
now I
video was
don't
like, I
know
was like,
much
this is like,
about this stuff, but it's kind of a fascinating video. That, and actually James Johnny's recent one as well, like just well worth a look.
yeah. But the James Johnny, everybody knows he's an asshole. Come on. I'm just kidding. I'm just kidding. He's a good friend. He's a good I'm kidding. He knows I'm joking. Uh, Okay, so I do have to ask you, or if somebody says, "Mr. Yeah, it would be a good interview." A Ponzi.
That's kind of I made a video about Charles Ponzi. That was kind of my first video that got big on YouTube. And the thing I find fascinating about him is just that it's not obvious that like you read it and you kind of think you go through the story and you kind of think, well, he's definitely a horrible scammer and an awful person, but it's not obvious that he knew it. You know what I mean? Like, because they've got all of the like documentation of like letters written between he and his wife and everything, and he was like a scammer down to his soul. Like when they let him out of prison for about 6 months, he started up like another Ponzi scheme down in Florida, like a land bank, and and he was a scammer in his soul. But the funny thing is, it's not obvious. Like I think he was sort of enough of a sort of dreamer to think he could make it work out. Like it's a crazy story.
He's like the scorpion from the Scorpion and the Turtle. You know that story where he just
Yes,
couldn't
yeah.
help himself. So this is a good one also. I forgot his name, but the CEO.
Yeah.
But although I hear the CEO wasn't the guy who was actually in charge of the nonsense, it was the guy
But they
who ran
had to
away.
all know. It's kind of like Bernie Madoff, the way
No,
Bernie
but he had the
started
guy
trying
who
to
was
do
like
it all
the
himself.
no, the number 2 or number 3. He was like he ran away. They never got him. He's
Yeah.
there's a crazy story there.
Yeah.
So a few meme questions. Are you ready for this? Robert, we already demonetized. The fuck I'm watching? Question mark. You want to answer? Like answer what would be a good wrong answer? I can't say
I
it
think
without.
he's upset because he saw the thumbnail and you were like this, and then he logs in and he's like, Tom doesn't seem at all surprised.
I can recreate it for him.
It's like, I was sure Tom would be horrified, like someone had shown something awful to Tom.
Okay. Second question: is fraud legal? Question mark.
You have a legal background, Tom. I'm going to pass that one over to you.
No. Here's a compliment. I think this guy is legit, is a fair guy, and hasn't been exposed to corruption. That's nice. Okay. What else do we have here? Okay. Looking for an interesting question before we wrap it up. Okay, so this is a good one. So this is a thing I see keep popping up on my comment section. We own 80% of the float. So basically, the CEO of AMC came out multiple times saying that the retail owns about 80%, about 400 million shares out of the 500 million, which is the total pool. Basically, and I understand. So, would it not be counterproductive for such a high ownership of retail versus? Would you not expect a higher institutional ownership in case of a short squeeze?
Not really. Simply because this sort of thing, like what's happened with AMC and GameStop, and we sort of saw a similar thing with Hertz a few months ago and whatever. The thing is that one of the requirements to even become a meme stock is that it has to be sort of a little bit illiquid, because you couldn't do this with Apple Computer, right? Like it just couldn't happen because there's too many people, there's too much stock, it couldn't happen. So with I think it's almost required that retail own this much, because if you think, like, even I think GameStop, like there was what's his name, Michael Burry was an investor, I believe, when it was at its lows, basically as a value play. But there's a point at which it's no longer a value play and he's a value investor, so he's out, right? And it kind of requires, for this sort of thing to happen, like anyone who's in to sort of to buy a good business at a good price looks at it and they kind of go, well, like what is pre-pandemic, like before the cinemas had even been shut down, I think AMC was an $8 stock, right? Now they've issued more equity, and I think it was in a proper decline anyhow. They've issued more equity. I forget how much bigger the float is, and it's, where is it, like 58 or something like that now?
No, 500 million shares.
But what's the price? It's is it around?
I think low 60s or high 50s. I'm going
Yeah.
to tell you in a second.
So I mean, if you bought it 8, we'll say,
Right,
and they
59.30.
shut all the cinemas. And, the world goes really against that type of company. When it rallied to like 10, you were out, like you felt lucky. You're up 20%, right? Yeah. So, I mean, from 8 to, yeah, look at I guess like a 1-year chart on that, and we'll see.
Yep.
Yeah. So, I mean, like that first little spike there was when all of the sort of what's interesting though is I think there is some funny stuff going on with these though, in that because of the market cap increasing, both GameStop and AMC have kind of moved into into indexes, and so then those, kind of BlackRock or Vanguard or whatever actually have to buy some based on their market cap within the index. So you'll see some of that. And I think there's also certain ETFs that will own them, and their ETFs are rule driven, and they might rebalance monthly. And the rule will be they can't do an early rebalance. And so they might have seen one of these stocks really balloon in size. And obviously they're probably hoping to get out while the price is still up, but they can't until, the next date that's written in the rule book says they can exit. So, there will be institutional ownership based on those kind of indexers or ETFs that have that in the basket. But
Look at the difference, though. I think this spike, it was the January spike, the GME first round.
yeah,
It's probably here. So before I ask you the serious questions, Seawolf is suggesting that you send your tailor name, and I mean it's a good. I mean
yeah.
you have good suits.
Oh, thank you. I make them all myself. That's when I'm not on screen, I'm here sewing.
So okay. So here's a good question, which we can wrap up with. We kind of spoke about this. A lot of people don't remember that we had like our streams in the GameStop round one, and while the whole hoorah was going on with Robinhood, and you were basically on here saying, well, yes, Robinhood screwed up, and they did a poor job, but not because of what you think.
Well,
And you
Robinhood were undercapitalized, and basically, the nature of kind of how clearing works, they'll basically have been told, you have a position in something really volatile, you have to put up money, and a broker has to put up their own money. Like they can't put up customer money; they have to put their own money up for clearing, and so that will have been the problem. Now, someone told me, it might have even been on one of your videos, there's been some news about possibly one of the brokers or one of the
No, you talk about the
one of the
Apex lawsuit.
clearing houses.
The Apex lawsuit.
Yeah.
Okay, so yeah, I pulled it up on the screen. Hold on a second, I got it. Yes, so you're talking about the Apex lawsuit.
Yes.
Okay. Yeah, there was a. I know exactly what.
There's some sort of story, and I don't exactly remember it, but I forget exactly how it worked, but there might be something questionable in there. But I do, essentially, like, not to be a jerk to the people at Robinhood, but the problem is there's sort of a move fast and break stuff, sort of Silicon Valley kind of a broker, right? Like you've got Facebook as a broker, okay? And then they're undercapitalized. When they're asked for more capital, they didn't have it. I think they raised a ton of money. Like I think they might have raised, was it 5 billion or something like that in a couple of days, and they were able to then turn it back on. But one of the problems with dealing with not a great broker is that you're dealing with not a great broker.
So this is just to be clear about something here. Oh wait, I highlighted this by mistake. So a few ground rules here. So this thing, Apex is one of the biggest clearing firms in the market.
Yeah.
Incidentally, they don't clear for Robinhood.
Okay.
Because Robinhood, they self-clear. So Robinhood is one of the only companies that don't use them, but the Webull uses them. A lot of big players use them, so they're pretty big. So Apex got sued, and basically what they're alleging in the lawsuit is basically they're expanding the mechanics up here, which we don't have to go through. Well, I'll go through it real quick for the viewers. In order to execute a trade, retail broker dealers such as Ally Financial, Stash, blah 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 blah, Webull, whatever, use clearing firms and clearinghouses to guard against the risk of default of either buyer or seller unable to execute the trade. And they have this whole chart here, right? And basically, they're saying here, specifically, clearinghouses require their members, banks and brokers, to be well capitalized, which you mentioned earlier, to deposit collateral and to pay into default fund. These deposits are determined, amongst other things, based on the volume of trades placed by a broker and the volatility of stocks being traded. Both went up crazy in GameStop,
Yeah.
right? Both volume and volatility went up like insane. As a result of the inherent volatility of the stocks, when they say stocks, by definition, they defined it earlier, stocks would be GameStop, AMC, a cost, and all of these. Then the NSCC requested the defendants to pledge a substantial amount of additional cash as collateral when executing the trades. Instead of doing so, however, Apex, which was the clearinghouse, which was what Webull's CEO was on TV screaming, saying it wasn't us, it wasn't us. Apex decided to limit exposure by requiring the broker dealers to restrict their investors from buying but not selling any shares of AMC, GME, and COS. The ban lasted for approximately 4 hours until defendant Apex finally removed the restriction at 3 p.m. So basically, again, this is all alleged.
Yeah.
This isn't. It's just a lawsuit. We're just reading one side of it. But essentially, they're allegedly. I hate this is the only time I say it when it actually makes sense. This word for the first time in years. What they're saying is that they had a basically they had to basically it's a judgment call, and they took a judgment call that basically hurt a lot of people.
Well, there's kind of an interesting thing with the way clearing works. Clearing became much more of an issue after the credit crunch because there were all sorts of problems with Lehman and so on. But the clearinghouses are there to sort of ensure the trades, to make sure that even if everyone goes bankrupt, that the end investors get what they paid for, and that's a good thing. But there's sort of this interesting thing where the clearinghouse, in a way, its almost prime goal is to defend itself, right? So the clearinghouse must not fail. And that's very much how securities regulators feel as well. Like we can't have, because it would be an utter disaster if a clearinghouse were to fail. And the problem with that, of course, is that in volatile or difficult markets, like we'll say during market crashes or anything like that, the clearinghouse, step one is to defend itself so that it can defend the end customers. But what that can mean is that they can, we'll say if they really up margin requirements, which is a great way of defending themselves, the more cash in the clearinghouse, the safer it is. But the problem with that is that if there's a broker there who's sort of on the ropes, and the clearinghouse come to them and they kind of go, now we need 10 times the capital that we needed yesterday. It's kind of an interesting thing because it's sort of supposed to be there to sort of like an airbag for the market. But in many ways, it's there are situations where it could cause problems.
So you're saying that, I'm not saying specifically about Apex, but you're saying in this situation, a clearing firm might actually take this judgment call just because they think some brokerages won't be good for it if they ask it?
Their goal is, they only have one thing they have to do, which is make sure that trades that occurred get settled fairly for the end customers. They kind of don't care about much other than that, and so they just need to defend themselves, and thus they're kind of like an insurance company. They're insuring the trades that have happened, because trades, they used to settle in T+3, it's now T+2, so there's sort of a lag between trading and settlement, and they just need to make sure that the ones that were traded, that the cash goes to the seller and the shares go to the buyer, and they then defend themselves.
So I want this is I'm looking for the interview with Anthony. Can't find it right here. There was an interview which I was watching with Anthony, the CEO of Webull, which was actually very interesting what he said, but I can't find it right now. But he essentially was saying,
I do remember there was a bit of a scandal at the time.
He was on Benzinga. You remember he went live on Benzinga, and he was talking about it. So let's just read this part. Just like their client base, the broker dealers voiced their disagreement. So if they're talking about in general, but they don't talk about the. Oh wait, here it is. just like the client base, the broker dealers voiced their disagreement with defendants' illicit conduct, illicit allegedly. Yeah, we're reading this is just one side of the story. Allegedly. For instance, when asked why Webull decided to restrict the stocks, Anthony Diener, CEO of the trading app, stated that I didn't make the decision. The decision was made for us. He continued to state that I hope there's an investigation and with complete transparency. And then there's a different example of other brokerages that basically said the same thing. So
Well,
do you think
it's even interesting because I'm not sure who the clearinghouse necessarily has a duty to, like does it? Because in a way, their duty might be to the people whose trades have already occurred and not to the people whose trades are about to occur. I don't really know what the legalities would be around that.
But basically, I think the gist of it was when we spoke about this in January is that it's just the problem was not, you didn't feel that the problem was any sort of a sinister behavior, but rather trying to sell a bicycle dressed up like a Ferrari, so to speak.
Yeah, but I mean, that's even if you think about it, like why do people want to trade with some of the bigger, better capitalized, more institutional brokerages? And the reason is because you do pay more sometimes to trade with them, but you get more. You're dealing with like a solid product, and the problem, I don't want to knock these startup businesses. Like, every business is a startup at one point, but they sort of found themselves in quite a sticky situation.
JT says my brain is wrinkling.
I'm not sure if that's good or bad. I would see a doctor about that.
This is actually not a bad rule, by the way. I think it has a for margin accounts. I think in the US they have a limit on how much trades you can do per month.
I think it's based on how capitalized you are, or
Yeah.
something like that. You have to be above a certain level. Yeah.
02, we talked about this in the beginning of the show, specifically about this question. The New York Stock Exchange basically saying, and we agreed that yes, that's actually an accurate statement.
It's even an interesting thing. Like, I think even if you're someone who's involved in the trades, you have to like when you say that like a group of people control 80% of the float, that basically means that the stock is almost a private company at this point. Like, it's owned by a board on Reddit, rather. It's been taken private, right? And the price is sort of, who knows what the price of a private company is, and that's almost where you are with these things.
Talk about the Fed, damn it. What do you want us? You want us to talk about inflation? Yeah, we can talk about it. Sure. I would. I mean, ask more politely, I guess, if I was. But okay, we can. I guess we can. Do we have 5 more minutes, Patrick, before you have to go?
Sure. Yeah.
Okay. So, because here's the thing, Patrick goes and he has like grown-up things he needs to do. I'm just gonna go play PS5, so I have more time. Okay. So here's a question for you. Obviously, you're not really pumped about what's going on in the US and the inflation and everything, but I mean, you follow it a little bit, especially if you watch my videos, so you've seen my opinion on this. So you've seen my opinion. I think the Fed is full of shit. I think they know that things are getting much worse than they want Gen Pop to believe as far as inflationary effects and what it's going to do to the market. I don't think it's a doomsday scenario like a lot of these other idiots are claiming. There's no hyperinflation going, but there's definitely a lot of inflationary effects. I think that at this point, it's starting to be too late. I think that if they're dragging their feet about 2023, 2024, tempering and raising interest rates, I think they might not have time to get in front of this thing. And we might see like 80s inflation all over again.
Yeah, it's a very interesting. I made a video, I guess, about a week or two ago about like I stole your idea. I put flames on my thumbnail and I got way more clicks. So that's how I'm going to be going forward.
Dude, the minute you put fire in your thumbnail, it gets more clicks.
People love it, like yeah. The old bitcoins and flames going forward. But
the first time you do the Home Alone face, you're gonna have go 1 million views, bro.
Would you ever do it? I worried that I'd get like a copyright strike from Graham Stefan. He'd be like, no, This is going too far.
Okay, so on a
Yeah,
serious note, what do you
inflation,
think?
like inflation's a bit interesting right now because we're seeing prices of stuff going up, which is inflation. And I think, we're seeing like big numbers in the inflation numbers. But what's interesting is that a lot of it of late is tied to kind of supply chain disruptions more than anything else. And I think, the people who I speak to who know much more about this than me are saying that really the thing to watch is just wage inflation, because once wage inflation happens, then it can kind of spiral. But I talked a bit about lumber and things like that, and essentially you have this situation where everything kind of got shut off. Like I know some people in the oil industry, for example, and about a year and a couple of months ago, oil prices went negative, right? And it was basically just that they were pumping the stuff and didn't have anywhere to store it because people weren't using it. So then they start sort of slowly turning the taps off, and they don't want to turn the taps off because it's not a big tap. It's actually really hard to restart an oil well.
Yeah.
So eventually they shut this stuff all down, and then suddenly the planes are in the air and people are buying new Lamborghinis because they've made money in GameStop, and oil is needed again. And the problem is it's really hard to turn it on again and in any sort of speed. And there's all of these like blockages at ports and, even the semiconductor issue with car companies and so on. And a lot of the inflation we see right now is due to those sort of supply chain disruptions. And the Fed changing the rate of interest just would do nothing to sort of, cause more trees to be logged, for example. But if we see it in wages, it's a problem.
Oh, but I have to push back the second time today. I don't ever. It's the second time in one stream. It's kind of an unusual event, but I'll do it gently. So the interest rates. Okay, so I agree that there's definitely a transitory factor here. Obviously, you coming out of a cataclysmic crisis event, whether it's war or global pandemic. I just said war, we demonetized again. Whether it's whatever cataclysmic event you're coming out of, you're going to have supply chain shortages, not to mention the Suez Canal was blocked for like a month or whatever. So obviously there's that. However, that's probably just a partial explanation of what's going on right now. At least in the US, you can't just say, well, we printed so much cash and literally nobody's saving because all the money's outside. Nobody's on the bench because it's 0%. And you can't say, well, it's just all transitory. Of course, there's certain transitory aspects of it, but I mean, there's a lot of inflationary behavior. And the second part that you said, well, interest rates won't solve it. Yes, interest rates would not add more supply to the market. However, it will slow down demand. You increase interest rates, more people will save, less spending, less competition for the same amount of commodities, and so it has an impact, and it's definitely a good tool to solve this problem. But I think what you're alluding here in that part, I agree with, is you might cure the disease but kill the patient, which is what they don't want
That's
to do.
kind of the problem, right? Because we'll say this is sort of what they're discussing right now. Because we'll say, for example, if the lumber shortage has about worked itself out, but we'll look at the other products that have a problem, right? Well, let's stick to lumber because it's easy to discuss. So if the Fed
By the way, the
increased
people started with the Agent 47 thing again, even though you don't have the red tie today.
If the Fed increased interest rates, it would likely reduce the demand for lumber. But the thing is that they're trying to kickstart the economy a bit, and they actually would like to see more lumber mills be built and things like that. And so, you kind of, they don't necessarily want to kill demand. They want to probably bring on supply. And then it's a weird thing because even I got the whole, I was totally wrong back during the credit crunch. Like when they started printing money, I kind of thought this will be hugely inflationary. And I couldn't have been more wrong. And the reason it didn't become inflationary is just that they printed all this money and it all just sat there. And for money to sort of really turbocharge the economy, there's this idea of the velocity of money, which just basically means how fast it's bought and sold, like how much it's moving through the economy. And in sort of a lockdown economy like we've seen over the last year, in particular in places like Europe, the money just sort of goes to the bank and it just sits there, and people get zero interest rates, and people aren't, people borrow money from the bank to start businesses and things like that when they see business opportunities, and they don't really see it. There's no great business opportunities that people are looking at, and so the money is just sort of sitting there. And so if you saw the velocity of money pick up, you would see inflation from that money being there. But in a funny way, they've kind of printed it and it's in a big pile there at the banks, and the banks almost don't know what to do with it. And that's sort of what we're seeing. But that's kind of complex, kind of economic
This is
ideas.
I'm showing your point on the screen right now. So this is the reverse repo numbers for the US, which is literally exactly what you just said in numbers. So for those of you who are not familiar, should we do this? I mean, is this too geeky? I mean, we might
It's
lose
a
like
bit
500.
geeky, but we'll run through it quickly.
Okay,
If people
so
start leaving, we'll change back to something else.
okay, so this is not sexy stuff, but it's really interesting. So Patrick is saying basically, well, yes, his counter argument was definitely much more cash in the system, but there's not, because everything is out of whack, there's not a lot of investment opportunities, so the money's just laying there. It doesn't really cause any inflationary effects. So this is the reverse repo chart. The reverse repo is essentially is where the banks park their money overnight with the Fed in exchange for T-bonds. It's essentially when because banks can't hold the cash overnight for various reasons. Because for banks, I mean, I talked about this. Cash is a liability, which is kind of counterintuitive, but trust me, it is. So essentially, when the banks have too much money, they have to park it overnight with the Fed, and when they have to park it, this chart goes up. I'm just trying to keep it very, very simple. And as you can see right here, it was relatively flat for a long, long time, and you can see what just happened right now. It's up to, where do we at right now? I'm not even sure. 583, 747. Jesus Christ. So $747 billion parked overnight, when in April we had 3.
Yeah.
So
No, and that's the thing, is when you see, I made a kind of an interesting video ages ago on John Law, the guy who essentially kind of invented paper money, like, in Europe, a Scotsman in France. And it's actually sort of fascinating because he did all these things. It caused a huge bubble and then a bust. And the outcome was interesting, but it's interesting in that it's sort of leans into, like, what does money mean and when does it cause problems and when does it not, and the truth is, like, a lot of what's happening in the economy right now, it's frankly a big experiment. You know what I mean? Like, this sort of thing hasn't been done before, and they're acting like it's all normal. It's not normal, and therefore we can't fully rely on history to sort of say what will happen. I was surprised that the market was so shocked that the Fed said in 2023 they might start hiking rates, because it's kind of like, do
I was
people
shocked.
really think it's zero forever?
No, but I was shocked they didn't say next year. I was like, he has to raise interest next year. He has to. And that's even a little bit too late. Look at what's going. Almost $750 billion of money the banks have nothing to do with. It's just laying in the bank. That's an admission of guilt by the bank when they have to put money in a 0% T-bond overnight. It means, like, we don't know what the fuck to do with the money.
Yeah, well,
Demonetized again. Shit.
I've been reading a book recently by a guy named Michael Pettis. He's an economist. He's based out of China, and he's got some very interesting points which I can't explain because I'm still trying to understand them. But I would recommend. He's on a lot of blogs. If you Google him, you'll find him very interesting. But he basically explains a lot about how the money supply works in terms of investable opportunities or not, and he explains that, we'll say in China, like an emerging market 20 years or I think 30 years ago, any money that was sent to China could make money simply because there was so much need for stuff, any kind of infrastructure, any kind of anything. But in other, like in the United States and places like that, all of this money turns up, and they've mostly kind of got the stuff they need. Like, there isn't this huge gasping need, like, to build schools and build roads and build trains. And so you kind of find a situation like this.
Wait, where is this? This is the funniest comment of the day. I love it. This is brilliant, LeBel. Shout out to the 2,000 people who hang out with us for the past an hour and a half. This is 2,000 more than I initially thought with this kind of boring topic, but the clickbait worked. We clickbait the hell of this video, and the fire, and you with the the evil James Bond look like it worked to perfection. I hope you guys enjoyed the stream. Patrick, you killed it as always. Thank you so much for stopping by. As always, we go over the limit of the time. Thank you, everybody. Patrick says something about the Greek stock market.
I don't know anything about the Greek stuff.
Yeah, sorry. I love Greece, though.
Yeah.
Thank you, Patrick. Thank you, everybody in the chat.
Yeah,
It's
thank
been
you
a
guys
blast.
for signing in.
Yeah. Make sure you go and subscribe to Patrick. It's Patrick Boyle on YouTube.
Yeah.
On
Tom
Sorry,
says
Patrick Boyle on
it's your
Finance.
second favorite channel.
It's actually what's my first favorite channel?
Your own one, you know.
Oh,
I love this content.
I watch my videos all the time. I'm not
this
gonna lie.
Russian guy is the best.
This concludes the Rambling Show. If we ever do a podcast, we'll call it the Rambling Show. It's a good name. Or we might just call it Not Financial Advice. Patrick, thank you so much. Thank you, everybody. We're going to have to sign off. Thank you, everybody.
Yeah, it was great fun. See you guys later.
Have a great day.